Welcome to The Explainer. Today, we are digging into the wild, contradictory signals coming out of the crypto space. Because, let's be honest, right now it feels like two completely different markets are operating at the exact same time. Okay, so let's just jump right in. How is it possible that on one hand, you have the biggest, most serious names on Wall Street pouring billions of dollars into regulated crypto products, while on the other hand, you've got everyday traders getting absolutely wiped out overnight on these unregulated meme coins? How can both of these things be true at once? And look at this. Here's the core conflict in raw numbers. You have almost $2 billion flowing into regulated institutional-grade Ether ETFs in just 5 days. Then you look at the other side, $74 million lost by over 51,000 traders on a single meme coin. It really feels more like a high-stakes casino than an investment market. So here's how we're going to break this down. First, we'll look at Wall Street's big bet. Then we'll venture into the Memecoin Minefield. After that, we'll see if there's a middle ground emerging. And finally, we'll try to make sense of these two crypto worlds coexisting. All right, first up, let's talk about the sophisticated institutional side of the market. This is the buttoned-up world of high finance, and they are making their move. And we're not just seeing some casual interest here. We're seeing a really clear preference emerge. I mean, look at this chart. In just 5 trading days, spot Ether ETFs pulled in more than 10 times the cash the Bitcoin ETFs did. That is a massive rotation of capital. So why is this happening? Well, industry leaders like the CEO of Van Eck are basically calling Ethereum the Wall Street token. And the reason is all about utility. The Ethereum network is the foundation. It's the backbone for the biggest stablecoins and for tokenizing real-world assets. You know, the exact things Wall Street actually wants to build with. You know, even the way the market talks is getting more mature. Take token unlocks. This month alone, we're set to see over $4.5 billion in tokens get unlocked. A few years ago, that news would have caused absolute panic, with everyone screaming about the market getting flooded. But now, the conversation is completely different. And what that means is that the smart money, the sophisticated investors, they're moving past just simple supply numbers. They're now digging in and analyzing a project's real fundamentals, things like user adoption and how it's governed, instead of just freaking out about short-term supply changes. It's a huge sign of a maturing market. Okay, now let's take a trip to the other side of the crypto universe, the Wild West, where fundamentals, well, they often take a back seat to pure, unadulterated hype. Case in point, the YZ token. This was a meme coin that exploded in popularity, attracting over 70,000 traders. But here is the brutal reality. For almost 3 out of every 4 of them, it was a losing bet, a big losing bet. That means over 51,000 individual people lost a collective $74 million. Just gone. So where did all that money go? Well, the profits ended up concentrated in just 11 wallets. 11. And they each walked away with over $1 million. This isn't investing. It's a game of extreme asymmetric risk where the house almost always wins. And look, these aren't just one-off events. This kind of predatory activity is poisoning the well for the entire ecosystem. The number of daily traders on Solana's decentralized exchanges has absolutely plummeted, from a peak of nearly 5 million down to 900,000. Why? Because regular people are getting burned out and just leaving. But is there a middle ground? I mean, is it even possible to succeed in decentralized finance based on real value and actual utility, not just hype? Well, let's look at a project that seems to be pulling it off. So take a look at this decentralized exchange, or DEX, called Hyperliquid. In August alone, it processed over $350 billion in volume, generated over $100 million in fees, and now it controls 2/3 of the entire DEX market. This isn't hype. This is real, tangible economic activity. And its success comes from this really elegant, self-reinforcing cycle. The more people trade, the more fees it generates. Those fees are then used to automatically buy back the platform's own token from the open market. This creates constant buying pressure, which directly ties the platform's usage to its token's value. It just makes sense. And this is why prominent people like Arthur Hayes are paying close attention. He calls it a decentralized version of Binance with better execution, and he's predicting it could actually beat the big centralized exchanges just by being faster and more efficient. So after all that, what does this mean for you when you're trying to make sense of the crypto space? Let's pull it all together into a clear framework. The key takeaway here is that we're not really looking at one crypto market. We're looking at two completely distinct ecosystems. You have the institutional market, it's regulated, it's driven by utility, and it's focused on long-term fundamentals. And then you have the retail casino, driven by hype, short-term speculation, and just incredibly high risk. And that leaves us with the biggest question moving forward. As these two parallel worlds keep expanding, can they even coexist? Or will the regulated institutional world eventually force the speculative casino to either clean up its act or just fade away into irrelevance? The answer to that is going to define the next chapter for all of crypto.